So, I build, and my team, we have engineers, we have statisticians, we have all kinds of people who are really interested in sort of the math and the embedded sort of details of building portfolios. But at the end of the day, I really work for you and Brad, and I work directly for Brad. My job is to build solutions that make sense for his clients, that take care of his clients, not only for today, but for the long term. We build things for investors. Brad is what's known as a fiduciary, and we work exclusively, really with fiduciaries, which means that his job is to put your interests first over his own. And that's a beautiful thing. And it's part of why I like this business, why I can relate to it. It's much of the way lawyers work, and I hopefully you guys have had some positive experience with a lawyer, but a lawyer is supposed to really work for their client first and foremost. And so, Brad's job is the same way. I act as a fiduciary in this investment space through him. Again, trying to build products that really serve your downstream best interests. So just want to make sure, how everybody knows how that works. I really work for Brad, and Brad works for y'all. And so we're sort of all pulling on the same rope. And I think that's incredibly important to understand about the relationship that you guys are either in with Fiat or in with, or looking to be in with Fiat. So really incredibly important. I think the most important thing I could tell you today, and I'm going to talk a lot about investing, and probably maybe more than you even want to hear, but I think more important than any of that, if you're going to choose an advisor, you need to make sure you're choosing someone who's acting as a fiduciary, that's not selling you something, that is actually trying to build you something that benefits you and your family and changes lives long term. So with that said, I got into this, Brad sort of mentioned that I was a lawyer in my previous life. I spent my first decade in my 20s and even into my early 30s as a litigator. I spent all my life in courtrooms defending and suing people, depending on the case. So how I got into this was I had a really sort of bad investment experience in my family. My granddad was a plumber. I did not come from money. Literally grew up, or my family did, on dirt roads in South Arkansas. My granddad worked very, very, very hard, sold his plumbing contracting business in the early 80s when he was in his mid 60s. He then spent the next about 13 years of his life before he died in 1997, sort of investing his money. And when he died, he had for our family, a large estate. A financial advisor, stockbroker, bank firm came to my family, my mom in particular, and said, we understand that your father has passed away, and we would love to manage and take care of this money. And we're the right people to do it. We have the tallest building on the square and the fancy suits and a long table to sit at. And so my mom asked me, does that make sense? And I said, well, yeah, I don't know anything about investing. They do have the tallest building on the square, and they have a name that everybody knows, and sure, let them manage the money. Well, they took over this estate in 1998. My grandmother died 11 months after my grandfather. And so they had all this money. And again, not a lot of money to perhaps you folks, but a lot of money to my family. And the tech bubble burst in 2000. And by 2002, they had lost about 56% or so of my granddad's estate. And my mom came to me and in tears that, she really felt she had let my granddad down, and, wanted to get to the bottom of it. And of course, I'm a lawyer, and I was like, I'd be happy to sue this bank and these stockbrokers. I'll get to the bottom of this. And so when I tried to go get to the bottom of this, I quickly realized that there was no bottom of this, that this is just how business was done. You invest, you don't really know what you're invested in, you trust these people, and they invest in whatever it is that they think is right, and that may have to do more with their own pocketbook than what's in your best interests in many cases. And when the stock market blows up and drops 50 or 60%, I was told that, get ready, you're going to lose 50 or 60%. We hope you'll stay with it, and we hope you live long enough that you can make that money back. And that's just the way it worked. And that was a shocking reality to me, because again, I was a lawyer. I was trained to do things affirmatively. And so this sort of passive idea of just of the way this business worked was really not only offensive to me, but was really just shocking that that could actually be a business model. So, and I'll speed this up because I know everybody wants to talk about investing, but I think it's important to understand my experience because you may be able to relate to this a little bit. At the same time this was happening, and this was in 2002, I was involved in a major catastrophe, if you will. A NASCAR bridge collapse occurred, a pedestrian bridge outside of the Charlotte Motor Speedway in North Carolina. And I was representing some people who were very seriously injured. And in lawyers' parlance, I figured I was going to get a nice judgment or a settlement out of this case. And after understanding all I understood about this investing world, I knew that I was never going to trust a stockbroker or a bank or one of these so-called financial people to manage my money. And so that sort of started me on a path in the early 2000s of trying to learn about this business and what made sense to me, and maybe a better way of doing things. And from that, Brad's alluded to the fact that we formed this as an official company in 2007, and has grown exponentially since that time. And today, we build portfolios, model portfolios for guys like Brad. We listen to what he wants, what he needs, what he's hearing from his clients, the people that really matter out there, the people we're trying to change the world for. And we build products to try and meet those needs. So, that's sort of maybe a more than you wanted to hear, but I think it's important for you guys to know, where I came from. I did not work at Merrill Lynch or, Morgan Stanley. And frankly, I had an undergraduate degree in psychology. So I didn't come from the finance world. And, I got into this as a result of what I think was real weaknesses in this industry. And as a result, we've been able to maybe address those weaknesses in a unique way because we had a fresh perspective. We built, I was my first client. My mother was and still is my first client. So I'll shut up.
If I can summarize just for the sake of conversation, what I took away from your story, and I love your story. It's obviously not the first time I've heard it, but you really got into the industry because you just, from what happened to your family, was just, there's got to be a better way to get this done. Just riding the ups and downs of the market with no recourse and watching your grandfather's estate disappear was just enough to have you make a change. Even though you had as much success as you were having as a lawyer, constituted a complete 180 in life to prove them wrong, that you could get this done in a way where you just didn't have to ride the roller coaster. Is that fair?
Yeah, I mean that's absolutely fair. It just made no sense to me. On the front end, I felt like that certainly our family did not understand the risks of investing. Perhaps my grandfather did, but he was no longer with us to guide us. So we really relied on the sort of standard in the industry, which in our case was just really lacking in what I thought was substance and importance. And we'll get into some of the things we've tried to address about this, but just not understanding really what you're getting into, what risk really means, what is likely to happen when things get ugly, and things always get ugly in investing. Really does, it's important, to be able to understand those things and know those things so that you can build a process and stay invested and sort of, have a plan. And I just didn't feel like that the industry really provided a lot of that. It was sort of like they provided as much as regulators, require them to provide. They just do as much as they have to do. And I just don't think that's the right way to do business and something that's this important, life-changing. So,
well, it's a really interesting point too, Chad, just because perspective, it's really hard to have long-term perspective. And the reason I bring that up is because here we sit, it's 2021. Market's having a little bit of a tough day today, but if you snap a chalk line over the last basically 12 years, it's been awesome. We've had some blips, right? It's not been perfect. It's not been a straight up line, but for all intents and purposes, the S&P is more than tripled. And so this idea or concept of you talking about, hey, when things get bad, what's your plan? And things will get bad. We see it a lot. Just people don't think about it right now because it just hasn't happened for a long time. Their portfolios have just skyrocketed, which is awesome. Good problem to have. But to your point, what's your plan when it's not doing that? And then you start relating that to, retirement and how that overlays with sequence of returns and all these other risks that are associated. And it's just an important point to make. So I just wanted to make sure that stood out. So that being said, Chad, what I want to start with, now that we kind of got to know you a little bit, I appreciate you sharing your story. I think this is the second time I've seen you in a collared shirt. I mean, I don't mean to call you out.
Oh,
I
only
told
one
you didn't have to
fourth.
dress up. But I appreciate you putting a collared shirt on. So what I want to start with is just kind of high level. So what do you do? So you have the problem, right? And you saw the problem of just riding the roller coaster. And so you formed a Cabana to try to solve the problem. And so starting at the highest level, what in the world do you do? You're a tactical asset manager, right? And so what I want to know, or what I want the people to understand in the first question is, what in the world is that? And fundamentally, what makes Cabana different, so that roller coaster can be smoothed out?
So, and this goes back to sort of my introductory comments of my background and trying to build something that made sense to me. And so, when I really started looking at this concept of investing, I wanted to break it down into something as simple as possible, the true fundamentals. You can watch TV and watch one channel and they'll tell you this thing, and you watch somebody else and they're telling you another thing, and somebody else is telling you to look for this and that. And so, what I really wanted to do was to take all the noise out of that process and really focus on what really matters in the world of investing. And I think that there's a lot of confusion out there in the meaning of investing. So, investing is, devoting capital, money in this case, into a project that you believe is going to give you some sort of reward over a period of time, that you're going to have a return on your investment, and that's really fundamentally what should be focused on. But instead, we're all focusing on what's happening today and how this is affecting this, and is there a short squeeze? I mean, if you watched the news yesterday, there's an incredible, all the stuff going on with, the short squeeze of GameStop and this and that. And that's all just noise. That's not investing. That gets into speculating and trading, and which to me is much more akin to gambling than investing. So, and certainly people do that, and there's nothing wrong with day trading or swing trading or getting into that. That's their business. But that's not what I was about, and that's not what I'm about today. We're really about investing, and investing can be very, very simple. It is very, very simple. If you can take all the noise out and you really look at what matters, and it's a couple of things that if you can do these things, you will be successful. If the sun continues to rise in the east, the world continues to spin the way it has spun for thousands or millions of years, depending on your personal beliefs. There's only a few things you've got to do to be successful, and that is, number one, you have to engage in investing. You have to get involved, and that sounds easier than it is. And I can tell you personally, when I first got involved in this in 2003, which is when I began this sort of passion, this endeavor to learn as much as I could and to begin, this evolution of where I am today. I can tell you that even getting invested for me was very difficult, because I was questioning so many different things. I had so much information that caused me concerns or fears, or when do I do it, or when's the right time, or I'm seeing that this may happen and maybe I should wait. And so I don't think we should ever discount this concept of getting engaged. You have to get invested for investing to change your life and to be successful. So how do you do that? And there's several ways that I've seen people do that. And I can tell you what makes sense to me, but there's one way is, you do what my mom did and what I did, and you just go, okay, take the money and do whatever you do. I don't even want to know about it, and so, I think a lot of people ultimately become so disenchanted or lost in the weeds that that's what they do. That's their only way to get into the game. Yeah. And the problem with that is, if that's your your answer to getting started in investing, it leads to a lot of problems down the road because you're not able to fully understand what you're doing. And as a result, you don't have any reasonable expectation set for what's going to occur. And the problem with that is when those expectations are ambiguous or unclear, or they're not met due to a lack of information or whatever the circumstance, it causes people to make bad decisions later on. And this is true not only of people out there who are investing in their 401ks or saving. It also puts pressure on investment advisors, financial professionals. They make bad decisions if they don't understand and have expectations. So I think that's a huge part of it is, number one, getting invested, starting. I don't know, Brad, what's your experience on talking with people about getting invested? But I think that's a critical component at the beginning of the process. You've got to start, and you have to have, in my view, an understanding of the investment for that getting invested process to work long term.
Jed, I mean, just to add to that, I think that we say this all the time. Actually, my business partner, Matt Stahl, I'm stealing his words, but there's no lack of information these days, right? In 2021, you can find anything that you want, right? With the internet and Google and all those sorts of things. The problem is the lack of wisdom of what in the world to do with the information. And so I don't necessarily see it as a problem for most people to get invested. Most of the people that we interact with are invested. I think the biggest problem is they don't know what their investments do or why they do what they do. And because they have that lack of understanding, they make decisions that they probably wouldn't make otherwise if they fully understood the ramifications of either investing in what they had invested in when they did it initially, or the decision to get out of it when they got out of it, or whatever it may be. It's hard when you can't make sense of what you own to justify owning it, especially, to your point, when stuff hits the fan. When the markets are all going up and everything's hunky dory, nobody really cares. Even if they don't understand what they have, all they know is they're making money. Everybody questions everything when the markets go down. And then they start to lose money. And then that's when that lack of understanding, to your point, that's the killer. It's the killer. So that leads into kind of this next question. So speak again to the tactical side and kind of what the difference is between kind of just a passively managed portfolio versus tacticals. And then wrap into that, Chad, if you would, in that tactical management, kind of at a really high level, how you get that done. So I know you've got algorithms, which is a fancy word. I know you've got a system called CARA, which is an acronym that we don't know what that means. But at the end of the day, if you're going to try to put parameters on how you're invested and understand what your outcomes should be based on the amount of risk that you're taking, it needs to be fairly systematic. And so can you at least begin to describe to us the system that Cabana's created?
Yeah. So the idea again is that, we're trying to get people invested, and I'm a big believer if people understand it, they're going to be more likely to get engaged, and certainly they're going to be more likely to stay invested. And so, and this is, to your point of what tactical asset allocation is, we're trying to be able to identify at the beginning of the process and throughout the investment process what is most scary to investors, which is loss. So, our algorithm is really designed to address that idea of how much money am I likely going to lose, and in fact, how much we at Cabana want you to lose when markets get ugly. And so, all of our portfolios have a numerical number at the front of them as it relates to drawdown. So whether it's the 7, the 10, the 13, 16, the 5, that tells us how much this particular portfolio is intended to draw down when things get ugly. Now, how do you do that? And this gets into the tactical nature. How are we able to protect that drawdown? Well, asset classes are all very much related. There's only 5 major asset classes. We can go through this really quickly. It's stocks is one, and with all different types. There's bonds, which are debt instruments. There's all different types. Real estate is I believe, an asset class and publicly available to buy and sell. Commodities, which are all things that we use in our lives or make, and that can include gold, silver, aluminum, oil, cattle, et cetera, which can be bought and sold and traded through public companies. And then finally, the US dollar, which is the reserve currency of the world. So there's only 5 asset classes that all money is in at all times, and they're all fighting for attention, if you will, of investors' money, depending on where we are in the business cycle. So what we try and do is recognize in a very broad sense where we are in the business cycle, and we sort of allocate capital to those asset classes and that top level sort of idea, that bucket, which perform relatively well at that point in the cycle. And then as the cycle changes, we reallocate very incrementally. We're not jumping in and out. We're in a very systematic way, reallocating into the asset classes that may be more favorable as the business cycle changes. And that's tactical management, which is what Brad was referring to. In other words, we're not just sitting there putting you in a portfolio that's 60-40 or 70-30, and then waiting on some event like your birthday or the next calendar year to readdress that or rebalance it, because of course your birthday has nothing to do with asset class performance, nor does it being January 27th. What does affect asset class performance is where we are in the economic cycle and interest rates and some other things that we're all looking at CARA, or the algorithm Brad referred to. So we're just tactically moving and blending portfolios in and out of asset classes as they become more or less in favor. And then we blend in other asset classes, right? Because there's only 5. And so if we think stocks are very attractive right now, if you're in our 7 or our 10, you're going to have some other things in there like real estate and bonds, and you may have some commodity exposure. You may have some US dollar exposure in there, so that you're hedged up when things change and get ugly. Like today's an ugly day. So if you're in our 7 today or in our 5, you're going to have some asset classes that, sort of hold up and perform a lot better than equities. When equities are having a really hard day like today or over a period of time, then you're going to have things in your portfolio that protect against a large drawdown, again, so we can stay within your number. And so we're constantly doing that as markets deteriorate. Conversely, when markets improve after like the spring of 2020, we add risk back on, if you will, by reallocating into asset classes that may be doing better, like stocks, when things get better in the market, so to speak. So that's the nature of tactical asset management. It's just that we're doing something actively in response to something that we believe is important. At Cabana, what's unique about us is we put it on the front of our portfolio. So there's no hiding anything. What the expected drawdown, what you're going to experience in March of 2020 if you're in our 10. You are going to drop, and we want you to drop 10% in that relatively horrible market. And 2020 is an extreme example, but we could use fourth quarter of 2018, or Brad could pick some other dates. But when things get real, ugly, when markets drop 20, 30, 40%, if you're in our 7, you're going to drop 7, and that, and that's your expectation. And, if you can see that occur and you see that that it worked, your expectation was met, then you're much more likely to stay invested. And that's what we really want. We want to minimize losses and stay invested. So those are really the 3 components to investing that are so simple: getting invested, and understanding the investment so you can set an expectation, have that expectation met by avoiding a large loss, and staying invested. And if you can do those really 3 things, it's that simple. Over time, you win. And so that's really
stay invested if you avoid the large loss, right?
That's right. That's right. And
unfortunately, usually where people get out is when they hit the loss that they didn't anticipate or understand with the way that they were invested, what was going to happen if things went south. And it's not a matter, I guess it's not a matter of if, it's a matter of when, right? We just all know if you got at least 5 or 10 years left in you, 20 years left in you, where you're going to see pullbacks, you're going to see downs. And so just to kind of spit that back at you and make sure that I'm understanding and that the people are understanding. So what makes Cabana different and unique, and actually this is my favorite part, is it's just you had the goal to put in the name of your portfolios how much the client should lose if the markets and go south or things turn around. And so you've mentioned the 5, 7, 10, 13, 16. And so your portfolios literally in the name of them say, how much risk are you comfortable taking? If things go south, and when they go south, what can your overall plan stomach? Like, how does this fit into your life? And what kind of drawdown can you take on in your life, or what are you comfortable with? We call it the sleep at night factor here at Fiat. Like, I just don't want you waking up at night worrying about your money. That just doesn't make any sense. You shouldn't have a plan that brings about stress in your life like that, especially when you're talking about your life savings. It should be a positive experience. And so if that number is a 5% loss or a 16% loss or whatever that number is, you guys have just structured your algorithms in a way that say, okay, we're going to manage the money in a way inside of these 5 asset classes that have some different correlations. When certain things do well, others do bad, in a way that you have a very known, quantifiable, this is what's going to happen. Don't really have to worry about it. So when we're in the middle of a 30% drawdown in 30 days, like last year, that you're not sitting there fretting going, I hope somebody's watching my money. I hope that I'm not just riding this roller coaster like your granddad did, and his estate did. And that's kind of the whole premise behind what you guys do. Is that fair?
Absolutely. I mean, spot on. It addressed, again, who's the first client? I was the first client. My mom was the first client. What did I want to know?
Yeah.
How much money might I lose when things get ugly? And they're going to get ugly. I mean, I knew that much.
Yeah.
So it addressed that fundamental question. And we were just, I don't know if people say stupid enough or brave enough. And I talked to a lot of people, and I've heard both, to actually address what people want to know, which is, whether they tell you or not, how much money am I going to likely lose, when COVID happens, or, the fourth quarter of 2018? That's what people really want to know.
Yeah.
And if you can build a product that addresses that, then they're like, okay, I get it. I understand that. I don't need to have a PhD to do that. And then they can set an expectation. And then when they see that expectation met, then that's really the beautiful part of it, is not only we limited a large loss, which is key mathematically to investing success, but that person's engaged for life because they have confidence that they understood it and it performed as they thought it would perform. And so that's really the key to keeping people invested long term. And I want to talk just really quickly, the idea of avoiding large losses. I will not get into modern portfolio theory, but I would love to. Brad knows I would love to, but I won't, because y'all all go to
that'll be Chad Mason, unhinged investing 401 4-hour class that we'll offer at a later date.
So I can tell y'all this, that it is absolutely critical to avoid large losses when things go down. If the market drops 50% and you lose 50% in your portfolio, like my granddad did, how much do you have to make back just to get even? Well, the answer is 100%.
Yeah.
So, we can do this math, and we do this for guys like Brad. We have a whole schedule that we build that'll show you, if you lose 10%, you got to make 13% back to get even, or whatever. But the point is, you have to avoid large losses. And not only does that deal with the emotional side of investing and making mistakes when people get scared, but it mathematically deals with investing as well. So all of our portfolios are designed to do that by definition. But more importantly, or equally importantly, it allows people to address their ultimate fear at the beginning of the process, set an expectation. If that expectation is met, they stay invested, which is the final part of this. Just staying invested in a diversified portfolio. All of our portfolios collect dividends. We reinvest those dividends. Compounding and some other mathematical, beautiful things about investing then become available. So
it stands to reason though, Chad, because you got the 5, right? Which in the worst case scenario, as stated by the name of the portfolio, is a 5% loss. And then you've got all the way up to a 16% drawdown. That the 5% is obviously less risky, right? And the 16 is more risky. And so it's not that the 5 on the way up, when the markets are doing well, should perform as well as the 16, because there's more embedded risk in a portfolio that has the ability to draw down to 16% versus 5. So can you speak just to this whole idea of risk reward and efficiency of the risk that you take and how that's
so again, I won't belabor this point, but with an efficient portfolio that's mathematically sound and statistically sound, you should have the opportunity for more return relative to how much risk you're taking. So if you're willing to take more risk, like if you're in our 16 over time or our 13, you should have a better return than the 7 or the 10 over an investment horizon of 3 to 5 years. So, you can go look at, and I'll just use our portfolios as an example, but this would be true of all efficient portfolios. In 2019 was a great year. The market was up 30%. The S&P was up 30%. The Dow was up about 25. And if you look at our portfolios, our 16 was up 31%. The 13 was up 26%. The 10 was up 24%. The 7 was up 20. Now that's a great year. That don't expect that every year, but that's an example of a great year. Then you've got a year like 2020 where the market sold off 40% in 3 weeks. Well, when that happens, our 16 and our 13 are going to drop, around 16 or 13% before we've got all that risk out of there. And we want them to, because risk and reward are correlated. Yeah. So if it's not dropping that much, then we know there's not enough risk in there to have that 31% return like in 2019, when things are good. So they're very much related. And then, the 7, it's only dropping 7% when the market's down, dropping 40, and the 16's dropping 16 and the 13's dropping 13. So what's the result of that? So you got a year like last year, well, the 7 actually outperformed the 13 and the 16. And the reason it did was because it held that drawdown. It only dropped 7 instead of 16. So it doesn't have to make back all that excess loss over the rest of the year. Yeah. So, those are real world examples in 2 years of how you can see risk and reward work together, and how in some occasions, less risk pays off, through outperformance, either on the downside and even coming back out for a period of time. Now this month, and Brad knows this because he's seen our fact sheets, but we've had kind of a good, nice run in a bullish run. So you're now seeing our 13 and 16 overtaking the 7 and the 10, right? But for that period of time where, that savings, if you will, of not losing so much money really pays off and even results in excess upside performance.
So real quickly, just for the sake of, I have 2 other kind of bigger questions I want to ask. It's 11:40. I want to make sure we have time for questions at the end. And so I want to make sure I have time for these 2 more questions, but it sounds awesome, right? Like this idea or concept of, hey, when the markets go down, I want to know what my outcomes are going to be. And then, individually, we can talk through what the expectations should look like based on the upside with the amount of risk that you're willing to take. What's your appetite? And what should your expectations be? That said, last year, take the 7 as an example, which is pretty darn conservative. Market's off a lot in a very short amount of time. Did you get it done?
Yeah, I mean, we held, and you never know, how good your system is until you're truly tested.
Yeah.
You can think you're good and you think you can handle a situation until you're really faced with the real deal. So all of our core portfolios, which at that time were the 7, the 10, 13, and 16. Since that time, the 5 was an income product, which we've now converted to the regular portfolio. But all of our core portfolios held. That was, a real scary test. And it was even more of a test than some of I was investing in 2008, running money in these portfolios. And I was there all through the financial crisis. And I'm telling you, there was a couple of days in March of this year when we came really close to the precipice of true catastrophe, when all of the fixed income markets, the treasury markets locked up. You could not sell anything. And that was even, to me, worse than September of 2008 and some other times. So yeah, when you're really tested like that in 2008, like this year, that's what you want to see. That's where you test your mettle. What are you really worth? So yeah, we held, and as a result, of course, we've had a lot of attention and good things have happened because that expectation was met. But we don't sit on our laurels. We've now even actually aggregated all of the 2020 data into Cara, and Cara's now been re-optimized to sort of consider all of 2020 along with our database.
Gotcha. So at the risk of not being the guy that's just throwing you lobs and making you look amazing, because of course I'm biased and there's a lot of people on this WebEx today whose money you manage, at least a portion of their life savings. Talk to me about the flip side, because you guys, it's a scary time as an advisor, right? March of last year, market's just absolutely tanking and nobody really understands what's going on. I mean, when the market falls that fast, that quickly, I don't care who you are. It's a scary time, especially when for like us here at Fiat with that fiduciary responsibility, these are people's life savings we're talking about, and the market's literally just in free fall. And you guys dominated. You did extremely well for us. You did exactly what you said you would do, which is what matters, right? That said, the rest of the year, I don't think anybody would have predicted. Like with the way we came out of the end of March through the end of the year, the markets, not only did they rebound, but they ended the year up. And in the, towards the latter part of last year, specifically in the fourth quarter, you guys lagged quite heavily. Some pretty darn good returns in the fourth quarter of last year, and Cabana didn't really see any of it. And so we had a lot of clients that were just with questions like, hey, what's going on? Like the markets are, like November, one of the best months ever in the S&P, and they just didn't get to see a lot of that. Can you speak to what was going on at Cabana during that time?
Yeah. So, there is, and this is really, really important. This is as important as the comment I made about having a fiduciary as an investment advisor. There is no free lunch in investing.
Yeah.
Everything is related. If you give up something here to gain something here, and if you gain something here, you're going to give up over here. Yeah. So, we made a conscious decision, back in the early 2000s of what was important to me was avoiding losses. And I knew from all of the things that I had read and studied and, looking at math and the history of markets, I knew that if I could just accomplish, two things really, or three, if you want to start with getting invested, you got to start, but then two things, lead to success. And that is avoiding the large loss and staying invested. And avoiding the large loss goes hand in hand, as I've just described, with staying invested. But, it's very, very difficult to do both. It's very easy to avoid a large loss. You can get out of the market, right? As soon as Jim Cramer comes on, you just sell. And that's fine. You avoided the large loss, but what have you not done? Then you're not invested.
Yeah.
Alternatively, you can just ride it out like the bank told my granddad to do. Yeah. But then you're not avoiding the large loss. So to do both is very, it sounds simple, but it is simple, but mathematically there's something that has to be done. And that's where the tactical management comes in. But to your point, so our system is designed to avoid the large loss. That's what we do first. We avoid large loss first and ask questions later. We can always make up returns. So the reality is in September and October, markets were down 5 and 6%, which results in Kara looking at that, and she's noticing technically markets weak. Earnings are terrible during this time, which is a big part of Kara. She's looking at earnings. Interest rates have completely collapsed, which is another very fundamental aspect of the business cycle. So we go into November, having very much outperformed the markets all year. November, we're bearish. I think we went into November, we allocated on, I think, the October 28th, if I remember correctly, into truly bearish conditions, and very similar to the conditions that we were in the asset allocation we were in March, when things got really ugly, because Kara signaled and said, you've got to move. There is a train coming down the tracks. To protect your drawdown number, you got to move. Well, we had very similar circumstances in Kara, the algorithm, our system, at the end of October. So we moved into November very much bearish, hunkered down to protect against a potential large loss that we saw. We didn't see the train, but we could hear a train in the distance. And so what are we going to do? We are going to protect losses first. So who knows that two things are going to happen in March, which are, in November, which are really responsible for one of the largest jumps in the last, I think, 30 something years, maybe almost 40 years. November was the largest monthly return for the S&P in almost 40 years.
Yeah.
Who knows that the market is going to love a Joe Biden Democratic, election. So that's the first thing. The market explodes up, for 3 or 4 or 5 days when we're bearish. So we're now in hunkered down, low beta, things like gold, the US dollar, protecting your assets. Market explodes up 4 or 5%. And then what happens a couple of days later? Pfizer announces the vaccine, which may finally put an end to COVID. So market explodes up another 5%. Well, during this time, Kara's picking all this up because we're integrating this data daily, and we begin reallocating. But, we went in, the short answer is, instead of making 10% in March, we made 1.5 or 2%. Now in December, we were about equal with the market because we'd reallocated. So what happens is, the things that save you in a time like March on the downside hurt you in a time like November where the market explodes in the other direction. And so you've got to make a decision in your investing strategy. Where do you want your risk? Do you want to risk underperforming and only making 1 or 2% when the market goes up 10 or 11 or 12? Or do you want to protect, and you want to avoid the risk of losing 30 or 40%? And you can't have it both ways. It's very difficult. That's where the free lunch comes in. At Cabana, we've chosen, we would rather avoid the risk of the large loss and miss out on a month or two, because we know over time we win statistically. And you're seeing that right now with our portfolios. We caught up in December when the market performed. This month we will be, at or better than the markets because we've now reallocated and added the risk back on, if that makes sense. So that's a long-winded answer, but the point is really, you've got to decide where you want your risk, what you're comfortable with. Is it the risk of underperformance, or is it the risk of large losses? We want to address the risk of large losses. I'm not worried short-term about underperforming the S&P for a month or 2 months, because again, we're investors, not traders. That's the short answer. And everybody's got to make that decision for themselves, but that's the way we address it.
So I have one more question for you, and I'm going to switch to the Q&A box, and we've got some good questions that have come in. So thanks for those that have posed them so far. If you've got questions, keep putting them in there. I can promise you we're not going to get to all the questions today, but you will all get answers. And so I'm just going to kind of cherry pick a couple of them when we get there. But Chad, what I want to end with in my questioning is just kind of where you see things going. Like, so here we stand today. Last year was a really goofy year, with COVID and everything. Obviously, COVID's still here. We have a change in administration, and just I think we have some headwinds in front of us. But I'm just kind of curious, where you think things are going, what that means for Cabana relative to how you guys are getting things done, and then if you could, I'm at the expense of time. I'm scared to even ask, but like, if you could even add into that, what's kind of one thing that you want people to know, like that the average investor is not thinking about, that they should be thinking about, or something to that effect?
We put out a weekly commentary that Brad gets, and talking about generally where we are. I don't go into a lot of in-depth sort of calculations that Kara's looking at, in deciding where we are. But one of the things I love about what I do is I don't have to predict. I really don't care what the market is going to do today, tomorrow, or even this year. And I know that sounds silly for me to say that, but the point is, we have a system that is hopefully robust enough to address and move into the assets that are going to perform relatively well, despite what occurs, in the world out there. Because again, if you really break it down, there's only 5 buckets that all money has to be in at all times. And it's just sloshing from bucket to bucket to bucket, depending on what the perceived risk and return is out there. So I don't make predictions. And I love that. I just, Kara takes in the information, and we look at what's out there today, and we invest based upon what we're seeing today. I can tell you right now, Kara's bullish. Why is Kara bullish? You want to know. Interest rates on the back end.
She's positive. She thinks that things are, just to make sure everybody's.
Yeah, I'm sorry.
I know it's so easy for us to use our industry lingo and vernacular.
Yeah, and that's a good point. That's a really good point. People say bullish. Well, that just, what that really means nothing, because you can be bullish on bonds. You can be bullish on commodities. But when I'm saying positive, it looks like equities, stocks are going to outperform at the current situation. And here's why. All of last year, we saw markets make this incredible recovery. Well, it wasn't the broad companies that make up the United States that were doing well. It was 4 or 5 or 6 really behemoth companies like Microsoft, Amazon, Netflix. These companies, these large tech companies, were benefiting immensely from the lockdown and COVID and in our sort of pivot to technology to do business. Those companies make up an incredible, like 25, almost 25% of the S&P 500 and the Dow and these indices that everybody looks at and they say the market's up. Well, the market was not up if you're looking at all the companies. What happens is you've got 4 or 5 companies that are so big and they're doing well, it's pulling that index up. So what occurred last year is earnings were terrible for the vast majority of companies in the world, were the worst they've ever been. Interest rates collapsed, which means that people don't believe there's going to be growth out there. And that's why they're willing to take a very small pittance of interest in return for loaning their money. So that's negative. So what's happened in the fourth quarter, we've started to see other companies in the real economy beyond these 4 or 5 beginning to bottom out on earnings. And in fact, projecting more positive earnings, not great earnings, not earnings like we had in 2018, 2019, but at least getting their head back above water. And so Kara's looking at that and seeing that other companies in the real economy are now doing better. We're seeing interest rates begin to rise. That's a good thing. And people worry about inflation and all these things, but right now we need some inflation. That means that people have some confidence in growth going forward. And that's why we're seeing the 10-year treasury and some other longer dated, bonds, that yields are rising. That's a good thing. So that helps banks make money. If banks can make money, they're more likely to lend. And that generates the economy. And I won't bore you guys with all that, but all of those things are improving. They're improving from where we were last year. And so I think overall, that it looks very much more positive than it did 6 or 9 months ago. And of course, if we can deal with COVID and get this vaccine out there, then that's a game changer. People want to live again, so I want to be able to travel. I want to, see Brad in March and, whatever. So I think there's pent up demand. I think that this is just my gut. But as far as my investing of your money, I don't bet your money based upon what I think is going to happen. We have a system, a rules-based system, and I do not deviate from it. And the reason I don't deviate from it is because I have a long track record. We're talking about 15 years or more, almost 20 years of looking at data and knowing over time what has typically worked. It doesn't guarantee the future, but it's a large enough and robust enough database that's seen many, 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 many things. And if we can follow this system, then historically it's done what we want it to do. And so that's why I don't predict. But if you're asking my questions, I personally think we're in a much better shape than we were last year. Other companies are starting to do better, and that's a very good thing. I think you're going to see technology is the scary thing here. It has driven the indices up last year, as I've just described. They were the only reason indices were up, was 4 or 5 companies, and they are priced to perfection. And if you see earnings this week, that's why my commentary last night addressed this. If you see weakness in technical in tech companies, like Microsoft reported yesterday and did well, but if you see some of these tech companies coming in weak or weaker than expected, don't be surprised that we get a very quick, sharp sell-off. I don't know that it means that the year's going to end bad, but we may see some volatility, and I think that's what you're seeing this morning, actually, because they've started that process today.
Yeah. Awesome. I'm going to go to the Q&A box. Before I do that, I just want to kind of put our commentary in there and give some color as to, I guess, where Chad fits in the fiat life and on behalf of our clients. And so, everything that we've talked about, in fact, there was a comment made in one of the Q&A questions is, a lot of commentary on avoiding losses. What about realizing gains? Which is obviously also important. And there's a lot of people that even in retirement still need gain to kind of make things work and to make the machine run. But for our purposes, Chad, here at Fiat, and I've talked to you about this, but I just want to make sure everybody else understands, we use Cabana as a pretty core piece of what we do and what your team does, primarily because the most important thing to do once you've saved all your money is to keep it. the hard work's done, right? Like you've spent 30, 40 years of your life getting to a point where you have whatever pile of money it is that you have. And probably today it's the biggest pile of money that it's ever been. And so then the question becomes, well, how do I hold on to it? Make sure what happened to your granddad doesn't happen to, in his estate, doesn't happen to them. And so there's offense and there's defense, and so you where do you play defense and where do you play offense? And in any sport out there, I don't care if you're a football fan or a baseball fan, or maybe you don't like sports at all, but the bottom line is you need both, right? To be able to win national championships, to be the best of the best, you need to be able to, have a good defense and have a good offense at the same time. And at the end of the day, we always use the analogy of the El Camino, because the El Camino, if you're unfamiliar, is a car that GM made decades and decades ago, back in the 60s and 70s. And it was a good concept, right? This whole concept of, people like cars and they like trucks, we'll make a car truck. Well, the problem is you ended up with a car that seats 3 people and a truck that can't tow anything. So it's just a really crappy version of both. And so even if you love the car, it's not a good truck and it's not a good car. And so trying to play offense and defense at the same time, to your point, there's no such thing as a free lunch. And so Cabana's, I think, plays the most pivotal role for us and our clients in their overall financial plan. And that is, where do we play defense and how much defense do we need to play relative to the outcomes that you want and your comfort? And you're the only people that we found that are willing to put a number on the portfolio and go, here you go. This is how good the defense is. You want a stronger defense? We'll play stronger defense, buy the 5 or the 7. You're willing to, kind of sit back and play zone. We can get into the 13 or 16. And so it's all really important. Let me get to the Q&A here because we don't have a lot of time. In fact, it is 12 o'clock. Chad, is it okay if I keep you for 10 minutes to answer a couple more questions?
Yeah, absolutely, man.
Obviously, guys and gals at home, friends, family, clients, prospects, this time is yours. It's a Zoom. You can hop off if you want to, but Chad's agreed to stay for 10 more minutes. So one of the first questions that came in is, what are your priorities or kind of your key variables that you're going to be looking at for the next couple of quarters? You answered this a little bit in kind of your commentary, but what do you think is going to kind of drive the beginning of the year here?
Yeah, I mean, at the end of the day, it's going to be earnings. And so, we need to see the next, I really believe the next 7 to 10 days is going to drive stock prices and bond prices and all asset prices, for the next 3 to 6 months. And so we need to see these tech companies that have really led do well. They are priced to perfection. Yeah. And so if they miss, we're going to have problems. Everyone knows that, that the real world economy sectors, industrials, energy, financials, all of those have been in real pain, and they're still in pain. Let's don't kid ourselves. They're hurting. The service sector, restaurants, all of those things are in pain. And so we've had this one bright spot. I'm really worried if tech misses, and they're not as good as we think they've been, we're going to see a pullback, and it could be a pullback of, I'm just guessing here, 5, 8, maybe 10%. And I think the next thing people are going to look at is how quickly we can get rid of COVID. And that's a real, it's an issue. I mean, and I don't want to get into the politics of the world, but, the U.S. has struggled immensely with COVID compared to a lot of other countries. And if we can get COVID under control and we're confident about that, that's a game changer. So I think those are the things to be looking at. And I don't think everybody on this call probably knows that. I'd be looking at tech. I think the next 7 to 10 days are really important over the short term. Long term, the fundamentals are improving. Earnings are getting better. They are turning positive year over year. And earnings ultimately carry the day, guys. Everybody can talk about everything else in the world they want to talk about. But with respect to stock prices, which really flows down to other things, earnings is what it's all about. It's why you buy a stock, or in my case, I buy an asset class ETF, an equity ETF, is based upon my belief that those companies inside there are going to generate positive earnings. Yeah. If they do not, people are not going to buy them. They are going to sell them. So earnings is what I'm looking at.
So we have a lot of questions around Kara, from the simplest of who is Kara to some very complex questions, some very good questions. And so I don't think we're going to be, I mean, with the sake of time today, we're not going to be able to get into the details of CARA and the algorithm, which is just the name of the algorithm.
Yeah.
But it's an
So
acronym,
CARA,
correct?
it's an acronym. It stands for Cyclical Asset Reallocation Algorithm. So again, all we're looking at is the business cycle, and we look at some really fundamental things that define the business cycle, particularly interest rates. So we start with risk-free rate of return, the money you can get for putting it essentially in a bank or a short-term treasury note. And we look at longer-term interest rates, and that's called the yield curve. And that's what dictates how much money banks can make. So they borrow from us as depositors and pay us a pittance for your checking account or your savings account. And then they loan it back out to us to buy cars and houses at a higher rate. That's called the yield curve. The larger the difference between short and long-term rates, the steeper the curve and the more money banks can make. And that's what sort of controls the monetary supply in the country. So if the yield curve is steep, and of course, this is why the Federal Reserve is trying to manipulate the short end of the curve to try and steepen or flatten that curve to sort of control how much money is out there in the system. So banks want to loan money when they can make a bunch of money. So if the yield curve is steep, they're more likely to loan, which leads to companies being able to borrow for whatever it is that they do at reasonable rates, access capital, invested in their business, and then they make this thing called earnings, right? So the first two components that are just really critical to understand about the business cycle and what CARA is looking at is just this relationship between monetary supply and companies' ability to generate earnings. These are very much linearly or positively correlated. So if you see more liquidity in the system, which is monetary supply, companies are going to be able to access capital and invest in what they do if they're good companies and they grow their earnings. That leads to price. So just as you guys all know, if a company comes out with good, strong earnings and projects earnings to grow in the future, the price of that company, the stock, is going to go up. So that's the third component that we really look at. And we look at this data in an aggregated fashion. So we're not looking at just individual companies. We're looking at the entire complex of, for instance, the S&P 500 as to how it's doing in growing earnings and how its price is performing. And then, of course, we look at price over various time periods. So, we don't want to be day traders. So we're not looking at how the price is being affected today or tomorrow, but we do want to see how price might be affected over the past 6 or 8 weeks and how it might be affected over the past 8 months or a year. So we're looking at price over various time frames. We're looking at earnings, and we're looking at interest rates. We bring all this together into, as he said, an algorithm, which is just a fancy word for a software program that does a bunch of math, and it spits out generally kind of a number that tells us generally based on these circumstances of price, companies' earnings growth, and interest rates, where we are in this repeating business cycle, which is going on all the time. And it just tells us, it gives us a snapshot of generally where we are. And if we know that, we know what asset classes tend to perform well at that point in the cycle. And as that changes, then we respond by changing asset classes, right? By changing that mix of asset classes. Because if we've gone from here in the business cycle with these asset classes that perform well to here, we need to move the asset classes, right? And that's a big part of how we protect drawdown. And it really very much addresses the question of offense, defense. So there's times like in the past couple of months where we switched to offense. And that's why, you've seen us in these portfolios being relatively overweight in stock kind of things. And of course, that's why we made money in December and made money in January in those types of assets. Well, if this moves to here, we're going to move those assets. And so we'll be changing to something else. But that's a very short version of CARA. And I can get into more of the engineering of that if you'd like, but
well,
that's
obviously for time we don't have, but there's so many questions here that I would like to, Chad, I don't want to put you on the spot in front of 100 people, but
please put me on the spot. It's the most.
Can we
trust me, this will be the most fun thing I do today. This will be the most fun thing I do today. So take your time. Go ahead.
More of your time at a later date. If we were to schedule a follow-up that's specifically related to kind of more of the technical details of how you guys get done, what you get done, is that something we could do?
Absolutely.
Okay.
So, I'm not, we're not perfect. And I say this, I give webinars to advisors, we're not perfect. and we'll never be perfect.
Yeah.
But I can tell you that we try really, really hard every single day. And, we got a lot of really great people in our company who are constantly working on the things that we're talking about, trying to get better and including more and more data. And the bigger our database is, the more, the more robust our process is. And I can tell you by updating and constantly doing this, those are the things that allowed us to do what we said in March. If we hadn't have been doing all those things in 08 and 09 and 2010 and 2012 and 2016 and going through 2018, if we hadn't been aggregating and building on our database all those times to continually try and get better, we wouldn't have been able to do what we did in 2020. And so that's why we now aggregated and built 2020 into it, so that in 2024, when something like this happens, we're in a better position to handle it, because we've handled more and more things. We've seen more and more things. It's like that farmers commercial where the guys, we are farmers, why we do something great because we've seen a lot of things. There's some wisdom in that, right?
Yep. Yeah.
I want to say one more thing that your client asked about. You got to make money too. I'm a huge fan of Warren Buffett. I've read almost every book Warren Buffett has written, and I love Warren Buffett for a lot of reasons. But his first rule of investing is avoid losing money. Don't lose money. His second rule of investing is remember the first rule. So and it's so and it goes back to just how simple investing can be. If you can get invested, avoid a large loss, and just stay invested, and let this beautiful thing called compounding and time work in your favor. Because really, the stock market, the investment world is just a reflection, a mirror of us as human beings. And human beings are constantly evolving and moving forward and developing. And the markets just reflect that. So if you can just be a part of that and avoid the catastrophe, in the middle, because humans do make bad decisions and mistakes in between, you can minimize those, then over time, you should win. So that's my parting comment on
that's what it's all about. Chad, very gracious with your time. Thanks for staying back for a couple of minutes. I know there's questions that we didn't get to in the Q&A. I'm going to print them out. I'm going to try to work with Chad and his team behind the scenes to get kind of a Q&A write-up done. Questions we didn't get to, and we'll send that out to everybody that attended the workshop. Give us some time to get that done. It's not going to happen today, but we'll work on that. Chad, we'll work on getting you back on the horn for a special one-off, because we've got the whole Inner Circle workshop booked out for the year, but we'll schedule a one-off and we'll go through some more technical details for those that want it. I want to thank all of you guys and gals that joined us for the workshop today. We love the Inner Circle workshop. We're very passionate about education here. And that is one of the reasons that we love working with Cabana so much, is because understanding the outcomes that you want in life, so that your pile of money is not just a pile of money, so that it becomes pointed in the direction to achieve the outcomes that you want, is so important. We see it all the time, and people don't live the lives they should be living. They're avoiding generosity when they should be, because of fear. And so being able to take some of that fear out and being able to have a core piece of a portfolio at this stage of life where you just know what your expectations are, it drives so many other positive decisions. The impact and the wave that can have in the way that you choose to live your life is awesome. And we've seen it just in the short couple of years that we've been partnered with you, Chad. So you're making an impact up here in the North Midwest. So appreciate that. Appreciate the time.
Hey man, thank you guys. And I say this and I mean it. I just appreciate y'all's trust and the responsibility you placed in us. And it's something, we do not take lightly. So thank all you guys, and get involved in investing, whether it's with us or someone. Kick the tires, understand, trying to understand what you're getting involved in, and stick to a process that you can believe in, and you'll change your life and your children's and your grandchildren's, and that is a beautiful thing, as Brad said. So thank you guys very much. Brad,
with the disclaimer that if I offended anybody that is a big El Camino lover, I apologize.
I love El Camino. You offended me. I love the El Camino.
It's not a good truck and it's not a good car.
No, I know. So
thanks
cool.
for the time, Chad. Have a wonderful rest of your day. Everybody, thanks for attending. We'll see you next month.
You guys.